This video covers the first part of Chapter 3 pertaining to understanding the flow of costs in our job order costing system, booking some journal entries, and posting those to T accounts. So there's some definitions or vocab terms for us to keep in mind as we get going in Chapter 3 here. The first is our job order costing systems in general. Let's keep in mind that those systems are most appropriate for firms who are making products that aren't mass produced, or providing services that aren't the same from one customer to the next. So there's some level of customization or variation in products. Absorption costing is a costing method that we've been assuming really all semester, and that just says that all manufacturing costs, so direct materials, direct labor, and then all manufacturing overhead, variable and fixed, are included in the cost of a product. Allocation based or cost driver was another term for that, is any measure of activity like our labor hours, machine hours, labor cost, and so on that we use to assign costs to cost objects. And we use that mostly in the context of our predetermined overhead rates. So remember, those rates are calculated at the beginning of a period before anything's happened, and we use those to assign overhead costs to jobs as we work on them throughout the period. We always calculate our predetermined overhead rates in the same way, by taking our total estimated overhead costs for the period divided by the total estimated amount of that allocation base or cost driver that we expect to use during that same period. Overhead application is just the process of assigning or applying overhead costs to specific jobs. We're always using the same mechanism to do that. I don't love using the word formula here because it's not really a formula per se, but we just take the predetermined overhead rate that we've already calculated at the beginning of the period and then multiply it by the amount of the allocation base incurred or used by the job during the period. That's how we're always going to apply overhead. Now, normal costing is a costing system in which all of our overhead costs are applied to a job through that mechanism, by taking a predetermined rate by the actual amount of the allocation base used or incurred by that job. And then a job cost sheet we also talked about, or job cost electronic record if we want to think of it that way. Just some kind of tabulation of all the direct materials, direct labor, and overhead costs that have been charged to a specific job at any point in time. Okay, so learning objectives 1 and 2 then were to understand the flow of cost in our job order costing system and prepare appropriate journal entries, and then to use T accounts to show the flow of costs in our job order costing system. And I know those are everyone's favorite from accounting principles, and we're not going to use them a lot in this class, mostly just in this chapter. So a couple more quick definitions, some of which you're already familiar with probably. First is raw materials. So raw materials are any materials that go into the final product. We don't have to worry about traceability in terms of being direct or indirect quite yet. Raw materials is an inventory account, shows up on the balance sheet. It's an asset. Work in process, another inventory account, consists of all the units of production that are partially done and are going to take some more work before they're finished and ready to sell. Okay? Just stuff that's currently being worked on. And then finished goods, another inventory account. Those are all the things that, as the name implies, are finished and are ready to sell. Could be sold tomorrow. We have sort of a new definition here for Chapter 3, cost of goods manufactured. That includes all the manufacturing costs associated with goods that were actually finished or completed during the current period. So that's the manufactured part. You can kind of think of that synonymously with finished. Cost of goods finished. So there's this handy little picture in your textbook that I like to bring into the notes as well, because I think it does a nice job of sort of showing this high level flow of costs. If we look at our cost on the left hand side here, we've got our product costs at the top, raw materials purchases, direct labor, and manufacturing overhead costs. And then down here we've got our selling and admin costs. And we talked in Chapter 1 about how to differentiate between product costs, those are our materials, labor, and overhead, and our period costs, everything else, selling and admin. And really that differentiation was based on whether the cost was associated with that production process. Was it happening in and around the factory? If it was, it's a product cost. If it was not, then it's a period cost. We also use this idea in chapter 1 of inventoriable costs. And here's where we really start to see that kind of happening. All of our product costs, aka manufacturing costs, aka inventoriable costs, flow through the inventory accounts on the balance sheet. Period costs do not. They hit the income statement immediately, right? They're expensed in the period in which they're incurred. Now back to our product costs here for a minute. All those materials, labor, and overhead costs we talked a little bit about, or hinted at in the last chapter anyway, assigning these things to the inventory accounts. Raw materials purchases are going to show up right there in our raw materials inventory account. As we requisition materials for use in production, we're going to move those costs to work in process. We're going to do the same for labor costs, and we're going to apply overhead to work in process as well. As jobs are finished, we're going to move the costs associated with them to finished goods inventory. That's our cost of goods manufactured, the cost of goods that were finished in any particular period. And then when those things are finally sold, the costs get moved, if you will, to cost of goods sold, an expense account, which finally hits the income statement. So bottom line here, for all of our product costs, our inventoriable costs, they do not hit the income statement until the goods they're associated with are in fact sold. Another thing I like to point out here is that the flow of costs in our system should pretty much mirror the flow of physical goods. And kind of think of these things as rolling down an assembly line, if you will, as we're adding materials, labor, and overhead to work in process, where we're working on things, slapping them together, getting them closer and closer to being done and ready to sell. As they're finished, they move over to the finished goods pile. As we sell them, they move out the door to cost of goods sold. So see if you can answer this, given what we've read and what you've highlighted so far and what I was just speaking about. Evaluate this following statement. So generally speaking, the flow of costs in a job order costing system follows or mirrors the flow of physical goods. Is that true or false? That is in fact true. Again, we can see it really in that picture. We can think of the goods kind of moving through our production process here as they're being worked on, as we're adding things to them, we're adding costs, moving things to finished goods as they're finished, and then over here to cost of goods sold out the door as they're sold to customers. So that is true. Okay, let's use some examples here to look at some possible journal entries. So to illustrate the cost flows within our job order costing system, we're going to record some transactions for Ruger Corporation for this month of April. They're a producer of gold and silver commemorative medallions, and they're only working on 2 custom jobs here in April. Job A is a special minting of some gold medallions commemorating the invention of motion pictures. It was started during March and finished in April. As of March 31st, this job had been assigned $30,000 in manufacturing costs in total, which corresponds with Ruger's work in process balance on April 1st of $30,000. Job B was an order for 10,000 silver medallions commemorating the fall of the Berlin Wall and was started in April, incomplete at the end of the month. So it's still showing up in work in process at the end of April there. Okay, so let's say on April 1st, Ruger Corp had 7,000 in raw materials on hand, and during the month they purchased on account an additional 60,000 in raw materials. This entry may look familiar from your accounting principles class. We're going to book a debit to the raw materials inventory account. It's an asset, so increased with a debit for that 60,000 in purchases. And then since the purchase was made on account and not for cash or anything like that, we're going to credit accounts payable, a liability account, for that same 60,000. Now let's say during April, materials requisition forms, we talked about in an earlier chapter, were prepared to authorize withdrawing 52,000 in raw materials from the storeroom for use in production. Those included 50,000 in direct materials, 2,000 in indirect materials. So 2,000 in materials that we can't reasonably trace to individual units of product or jobs. This is what we'd book to indicate that activity. Any direct cost we're going to book, I like to say directly, to work in process. So we're going to increase the work in process inventory account for 50,000. representing the direct materials. We're also going to book a debit to manufacturing overhead for $2,000 to indicate the use of $2,000 in indirect materials. So these indirect materials, we're going to park those costs in the overhead account temporarily till we later apply them to production. Incidentally, real quick, for the overhead account, any debit to overhead represents incurred or actual overhead. Any credit to overhead, as we'll see, represents applied overhead. So to finish out this entry, we want to indicate that we've used a total of $52,000 in raw materials. So we're going to credit that inventory account for the same $52,000. Okay? Always want to make sure our debits and our credits match. Now let's show this flow of costs in our T accounts as well. Okay, as a quick rehash here, our T accounts, our ledger accounts, we have one of those for every account we have on the ledger. Debits are on the left, credits are on the right. That's always true. So if we looked at our raw materials account here, get debits, we're increasing that account since it's an inventory asset account. So our materials purchases from our first example would show up there. Any credits would show the use of materials, the decrease in that raw materials account. So there was our credit for our direct materials and our credit for our indirect materials. Now, as we said, our indirect materials, we're going to move to, at least temporarily, the overhead account with that matching debit. And then we had a debit for the direct materials over there in work in process. Okay, next up, let's assume in April employee time tickets were collected and showed 60,000 recorded for direct labor and 15,000 for indirect labor. Here's the entry we would have for those costs. So again, direct costs go directly to work in process. So we've got a debit to work in process for the 60,000 in direct labor. Then we've got a debit for the indirect labor of 15,000 poked over there to manufacturing overhead. Let's get our matching credit. We had a total of 75,000 in labor costs. It doesn't indicate we've paid them, so let's set up a payable here. Salaries and wages payable for 75,000 bucks. We could show that flow in the T accounts as well. There's our total entries in salaries and wages payable for the direct and indirect labor. Direct labor going directly to work in process. Indirect labor getting parked temporarily, at least, in that manufacturing overhead account. So T accounts, remember, really just a reflection of what we already booked in the journal. Okay, next up, let's assume that Ruger incurred the following general factory costs during April. So we had utilities for $21,000, rent on some factory equipment for $16,000, and then some miscellaneous factory overhead for $3,000. We might see an entry like the one shown here. A debit to manufacturing overhead for all of these actual or incurred overhead costs for a total of $40,000. That's the 21 plus the 16 plus the 3. And then a credit to accounts payable for that same total of $40,000. Now we also might have accounts like cash being credited if some of these things were paid in cash directly and immediately, like our utility bills, for example. But we're assuming for now these things are all on account. So we're recognizing that credit to accounts payable for $40,000. Same idea here. We've got a debit to overhead account for some other overhead, some actual or incurred overhead for the $40,000 we just spoke of. And then our accounts payable T account not shown here, but would be credited for that $40,000. All right, let's assume that Ruger Corp's predetermined overhead rate now is $6 per machine hour. Let's also assume that during April, 10,000 machine hours were worked on job A and 5,000 on job B, so a total of 15,000 machine hours. So our applied overhead for the period is the $6 predetermined overhead rate times the 15,000 actual machine hours run for a total of $90,000 in overhead cost. Now, overhead is always applied to work in process. We never apply it to any other inventory account. In theory, we should be applying overhead as we're working on jobs, so as things are in process. So always apply overhead to work in process. So the entry for applied overhead in this case would be a debit to work in process for $90,000, and then the credit to manufacturing overhead for that same 90,000. And we could see that on the T accounts as well. Again, credits to the overhead account represent applied overhead. Debiting work in process to show that the cost of work in process is increased by that applied overhead. Now, overhead is a control account, should have a zero balance at the end of the period. So if it does not zero out at the end of the period, we're going to need a year-end adjustment to take care of that. And that's the under or over applied overhead we spoke of briefly in Chapter 2. Here we also need to account for our non-manufacturing costs. Remember, those things aren't being assigned to individual jobs. They're not flowing through inventory. So they're just being expensed in the period in which they're incurred. So some examples there might be the salary expenses of all of our marketing folks, or our salespersons, or administrative staff, things like that. Also expenses like advertising, right, or any kind of delivery, or anything, again, incurred as a cost of selling or administrative function rather than production. So let's look at a couple examples there real quick. Let's say Ruger incurred $30,000 in selling and admin salary costs in April. Here's the entry we'd book for that: a debit to salaries expense, an expense account for $30,000, and then maybe a credit to salary and wages payable liability for the same $30,000 until they're paid. Second up here, depreciation on office equipment during April was $7,000. That entry would be a debit to depreciation expense for $7,000 and a credit to accumulated depreciation, that weird contra asset account from accounting principles, right, for the same $7,000. Now, one thing to add here, if this had instead said depreciation on factory equipment during April was $7,000, this entry would look a little different. Right? Factory equipment would be part of that production process, so it would be a product cost. Instead of booking depreciation expense, we'd be booking manufacturing overhead here for $7,000. Okay? And then we'd still book the credit to accumulated depreciation. And then finally, advertising here was $42,000, and other selling and admin expenses were $8,000. So here's the entry we'd have for that: a debit to advertising expense of $42,000, debit to the other selling and admin expenses for $8,000, and then a credit to accounts payable or cash if we paid any of these in cash for the total of $50,000. Okay, now let's assume that job A was completed during April, as we said earlier, and job B was incomplete at the end of the month. So we need this following entry here to indicate that job A was in fact completed during this period. We'd have finished goods debited for $158,000, the total cost of job A, and a credit to work in process for the same amount. Again, here's our sort of mirroring of the flow of costs and the flow of goods. As job A was finished, we want to move it, along with its costs, from work in process to finished goods. It's done and ready to sell. Now, because job B was not finished at the end of the month, its costs are still going to be sitting there in work in process. They're going to carry over to the next month. So if we looked at the balance sheet at the end of April, we'd see all the costs associated with job B that was still in process, $72,000, appearing in that work in process inventory account. And again, we'd see that flow of cost of goods manufactured, aka cost of goods finished, in our T accounts. Credit side for work in process, debit side for finished goods. Okay, another entry to think about here: what if we actually sold something? So let's say for Ruger Corp, 750 of the 1,000 gold medallions in job A were shipped to customers by the end of the month, and we billed the customer $225,000. Because 1,000 units were produced and the total cost of the job was $158,000, the unit product cost was $158. So we'd have two entries for that sale. Let's assume all sales were on account there. First would be to recognize the sale itself. So we're going to book a debit to accounts receivable, an asset account, for $225,000. That's what we billed to the customer. And then we're going to have a credit to sales or sales revenue, a revenue account, for the same $225,000. Then we need to update our inventory. So we're going to book a debit to the cost of goods sold account, that's an expense account, for $118,500. That's the $158 unit product cost times the 750 units we sold. And we'll have a matching credit to finished goods to indicate that those things are no longer in the finished goods inventory for the same $118,500. And once again, we'd see that in our T accounts if we looked. Got the credit side here of finished goods for the cost of goods sold, and a debit side of the cost of goods sold account for that same amount that we just booked. Okay, so think about this for a second. Your firm makes and sells automobiles. Which of the following costs could not be included in the firm's work in process balance on the balance sheet prepared at the end of the most recently completed month? Pause that, look through the answers here, and then resume, and I'll have the answer for you to check your work. So that would be D, commissions paid to salespersons based on the volume of products they sold in the period. Commissions would be a selling expense, so those would not be an inventoriable cost, right? They're not a manufacturing or a product cost. They would not flow through inventory, so they would not show up in work in process ever. Now looking at the other possibilities here, sheet metal used in production of the automobile, that's probably a direct material, so that could flow through work in process for sure. Salary paid to the supervisor of the production facility, that's an overhead cost, right? Indirect labor, so that would certainly flow through work in process at some point as well. And then cleaning supplies used by workers who perform tasks on the assembly line, again, since it's associated with that production process, it has to be a manufacturing cost. In this case, it's probably not direct materials because we're talking about just cleaning, equipment and things like that. So that belongs in that manufacturing overhead bucket as well. Okay, that wraps up the first video here for chapter 3. Feel free to back up and review everything you need to. Let me know if you have any questions, and then move on to the next one.